afternoon seem to be a tad bit quiet, with the Nifty and SENSEX both trading flat.
Right, Karanya. First, let's just quickly pull up the quiz question, because we got to give our viewers some time to answer that. They have till 11:45. And our question to you today is, which one of the following FMCG players has the highest gross margins? Your options were HUL, Imami, Dabur and Nestle. Few people have already tweeted to us. Please do so, and if you are correct, you might be featured on our channel at 11:45. Let's now take a closer look at the markets, and like Karanya flagged off, we've gotten a bit spoilt and used to a constant rally. But we can't expect a 140-point gain every day. So currently we are about 13 points down. So we're holding fort. We haven't really lost anything. We're around 13,100. The high point was 13,128. So we're slightly lower than there. Top gainers today: IOC, GAIL, Tata Motors, JSW Steel and Tata Steel. So metals are seeing a lot of price hikes, and of course auto numbers are coming in quite positive. So those are three of the top five. Then on the losing side today, and it's clearly the financials, you have the bank index, which is currently down 0.5%, but then you have HDFC Bank down over 1%, Kotak Bank down over 1%, Bajaj Finance down a whole percent. Then you have two IT heavyweights, Techem and Infosys, which are also down about 1%. So that gives you a flavor for what's really moving. And apart from that, Midcap index is holding up okay. Auto index is up 1%, and for now I'd say steady fort. And we'll see how we go towards the rest of the show. Okay, our guests are also with us, Kunal Bothra and Gaurang Shah. Good morning, gentlemen. Thanks for taking out the time as always. Kunal, coming to you first. A bit of a muted day, but I mean, is it really fair to call it a muted day, because we're holding fort above 13,000? And what's your high risk and low risk idea for our viewers?
Well, yeah, I think you can call it as a muted day, Varun. There are no two doubts about it, because we've been sort of accustomed to the kind of gains and the stellar recovery and the rally on the indices. So I think in that regards, it's been a muted start so far. Nevertheless, I think there are some specific observations related towards the market. Now, in the last 2-3 days, especially the start of the December series, the open interest of both the indices of the Nifty and the Bank Nifty is substantially lower. So I think, if I'm not wrong, in terms of the stats, the OI for Bank Nifty has dropped by almost 25%, and the open interest for Nifty has dropped by almost 18%. And now that could be one of the reasons why I believe that the start of the December series, the action in the indices has gotten a bit subdued, and the action is more towards the mid cap and the small cap end of the market. So I think in that aspect, I would believe that the market texture could remain a bit more sideways for the next couple of days, till the time you don't see some heightened activity coming into the open interest front for both of these indices. Now, I would suggest a couple of buy calls. Still expecting that many of the stocks and the stock specific momentum would continue. So the first one is about ICICI Lombard. I think that stock looks extremely attractive to me on charts. The last 10 to 12 days, we've seen a stellar move from this stock. I think from 1300 levels, 1320 approximately, the stock has jumped up to almost 1490, 1495, where it's currently trading. And I think even at current levels, it looks strong for a breakout on the longer term time frame chart. So would suggest a buy on the stock for a target of 1600 plus, and stop loss could be kept at 1450. We'll term this as more of a moderate risk idea. And the second would be a buy on Wipro. Now, this is interesting because, after, a stellar month in the month of September for many of these IT stocks, the last 2 months had been a bit, more sideways. But I believe on the, indicator fronts, many of them on the daily charts, I think Wipro is showing signs of a breakout on the indicator front. So I'm expecting that the mild pause, a 2-month consolidation could now get over pretty soon for the stock. And you might see one more round of upside coming into this name as well. So I would suggest a positional buy on Wipro from current levels of 356 to 57, targets of 400, and stop loss at 344.
Okay, Kunal, thanks for your high and low risk ideas. Gaurang, hi, morning. What are your wealth creation bets?
Well, thank you, Karna, and morning to all of you. So, yeah, I mean, I do concur with the view that maybe for, given the outperformance on the frontline indices, you may see large cap stocks going for a little bit of consolidation purely because of the run up, the shorter time frame, valuation and earnings outlook. So there is a possibility wherein your large caps may go in for consolidation and broader markets can tend to outperform going forward from here on, both mid cap and small cap. With that perspective, given the kind of outlook from a longer time horizon on the fundamental basis, we have two investment ideas. The first one is from the specialty chemical space, and the company is PI Industries. Stellar performance over the last couple of years, and a kind of a recovery, especially in the second quarter gone by, the numbers from PI Industries. Long-term, low-risk, fundamental idea with a target of 2,950 on PI Industries. And the second one is from the life insurance space, and this one is SBI Life Insurance. And we as a brokerage house, Geojit has been extremely positive on the life insurance sector. And you have very few names with a larger market share, credible names, and SBI Life happens to be this one. And given the kind of opportunity in terms of ensuring the uninsured, we believe that the larger players in this particular segment is going to have first mover advantage. From a long-term point of view, low-risk investment idea, SBI Life on the fundamental side with a target of 1,100. And mind you, Garanya, these targets would definitely tend to get revised upwards in case if the earnings to come by surprises out in the positive side.
Okay, thanks for that, Gaurang and Kunal. We're going to get to our queries after the break, but before we do, let's just pull up the PNSN stock cloud for today. And we have a whole host of interesting stocks that are comprising the cloud today. We have Phoenix Mills heading it with the GIC term sheet possibly coming, which might mean that Phoenix Mills moves to a REIT structure. Also, we'll be waiting, awaiting some further details there. But that stock is just zooming up in trade today. You then have Hero Motor, Eicher, Bajaj Auto. Obviously, auto numbers have been coming in and we've seen a good uptick in all these stocks. So clearly the information of the November numbers is being well received by the market. We then have NMDC related to the Doni Malai mines. We have an Escorts, which is also showing a decent pickup in numbers. We have a DLF, which is rebounding on the back of realty picking up. We have SpiceJet, which is looking to do cold chain delivery of vaccines via air, it seems. That's got that counter in focus. And then we have a Tata Motors as well, based on the recent November numbers just coming out. So the cloud this morning predominantly dominated by auto and then a few other select stocks. But on that note, time for a quick break. Stay tuned. We'll be back shortly.
Welcome back. You're still watching Buy Now, Sell Now, and it's time to address some of our viewer queries. First up is an email from Rushi Narvekar, based in Mumbai, bought Bajaj Finance stocks at a 3,500 rupees level, asking us whether he should book it as it has already rallied a fair bit, and is there any upside if it converts into a bank? Well, let's first analyze the technicals of Bajaj Finance with Kunal, shall we? What is your sense, Kunal? Do you think staying put is a good idea?
So I think it depends on the the thesis in which the investor has bought or the viewer has bought. So I think if the thesis was to just about play out this rally for the stock in the anticipation of the kind of event which has come out for the NBFC names, I think in that regards, then I think major part of the rally could probably have played out. You might probably see another 200 to 50 points. So maybe a sell on rallies could be a good approach. But when I look at the charts on the longer term basis, and we've seen how the compounding story has played out for stocks like Bajaj Finance and Infosys, etc. So I think in that regards, the viewer has bought at a very attractive price of 3,500. So there's a lot of cushion for the viewer as well in terms of the purchase price. So I think I would probably recommend a two-pronged strategy, assuming that the time frame which the investor is looking at is from a longer term view. I think at 5,000 odd levels, if the stock comes back to those kind of territories, I think you can book out partial profits over there. Then you might look at some bit of trading over here, but then don't let go of the entire stock or book out entire profits over here, because I believe that this is one stock which has risen quite sharply in the last 1.5 odd month, and I think it's a good quality stock given the kind of backdrop we've seen over the last 10 to 15 years. So I believe Bajaj Finance is a good stock which you should hold on from a longer term view. Just as a trading play, I mentioned that at 5,000 levels you can book out partial profits over there and look for some bit of trade over there.
Okay, great. Thanks for that, Kunal. Gaurang, how about you? Bajaj Finance guidance has been very positive for the next 2-3 years on the calls. And, it's a great business. So, given that he's bought at 3,500, would you sell a stock like this or just hold it for the next couple of years?
Well, so Varun, correct me if I'm wrong. I think end of March and April, just when this entire lockdown started, this particular stock, Bajaj Finance, corrected to as low as 1,900 or thereabouts. Correct me if I'm wrong. From there, and even earlier, if you actually go to see purely on the earnings visibility, corporate management kind of business that they have, the kind of products that they sell, this has been one of the best and the strongest performing NBFC stock. Now, it is a little bit premature to guess who will get the bank license and who will not, and how will it affect the business. So I'm not going by that. I'm purely looking at the existing business, the pedigree of the management, and the opportunity that lies ahead. And I'm quite convinced that this particular company, Bajaj Finance, will continue to deliver fantastic set of numbers, given the kind of presence they have on all the three trajectories: urban, semi-urban, and rural. So if you're not in a hurry and if you have the risk appetite, continue to hold the stock.
Okay, great. So quite clear message from Gaurang, and Kunal's also quite upbeat on it. Just suggested from a trading perspective, you could look at partial exit at 5,000 rupees. But that's good. So thumbs up for Bajaj Finance. Next query is from Atish Chabria of Mumbai. He's keen to invest in Phoenix Mills. He's seen the announcement today, the GIC term sheet, which is still non-binding. So but he's asking if it's a good level to enter. So the stock's currently up 13%. It's surged like a lot in the last month. I believe it's gone from 600 to around 770. So Kunal, do you think one might wait for a bit of a cool off in Phoenix Mills, or with the reopening trade and Phoenix Mills being a key beneficiary, do you think that there's still upside to go?
From a event perspective, you might see the stock moving up higher, because there was no I think in the last 1 month you had seen some traces of volume built up. Volume built up generally happens when there is anticipation of some event which could pan out for the stock price. And if you look at the stock in the last 1 month, from 540 levels, the stock had gradually moved up towards 660 levels. So maybe it could be time that you might see the stock moving up into a stable sort of an uptrend. But then, I think the next couple of days could be far more crucial to try and, identify and justify, this kind of a view. Because what happens is generally, before the build up towards, a certain event, there is a lot of volume built up. Just when the event, happens and occurs, you generally see distribution coming by or some profit booking coming by. So we need to see the texture of, the volumes over the next couple of days, whether there is, sign of profit booking into the stock, and which is why the volumes are moving up, or whether the genuine buying continues. I think that could probably be clarified over the next couple of days. If there is genuine buying into the stock price and the pace of rally continues, then you can expect even the stock going up to those previous 2020 highs of 900, 960 levels as well. So I believe just watch this for the next couple of days. If there is no trace of a major profit booking and distribution into the stock price, then I believe that you can hold on to your investments. Or if you're looking to buy Phoenix Mills purely as an event play, purely as a short-term play, yes, I believe that that could be a very good opportunity then.
All right. Gaurang, how are you sort of analyzing the fundamentals of Phoenix Mills, especially in the light of the recent deal that they've entered with the GIC?
So, Karanya, first of all, let me say this. This is a stock which has the tendency to be very choppy and volatile. And if you spin back in time and look at the history, then it will definitely reflect upon the choppiness and the volatility that the stock has exhibited. So first of all, you need to have a little bit of elevated risk appetite if you are wanting to get into a stock like Phoenix Mills. Secondly, yes, there has been positivity in terms of the businesses that they are into. And I'm not too, a little bit premature to say about this GIC term sheet. But purely on the business front and the outlook that lies ahead, it looks quite promising. So from a long-term point of view, we have a accumulate rating on Phoenix Mills. That means that don't invest your money at one time. Allocate maybe 30-40% right now, and on dips you can go on adding to it. But remember one thing, that this is a bit choppy and a volatile stock.
Okay, well, thanks for sharing your views on that. Quickly going on to our third query for the day, Anisha Chauhan writes to us from Gurgaon. She's bought 200 shares in ICICI Bank at 470 rupees a piece. She wants to know if she should add more at the current levels, given that the stock hasn't moved too much from that particular point. Kunal, coming first for technical analysis, help us out here. Should she buy more?
Well, you can look to buy more. I think ICICI Bank has relatively underperformed, other immediate peers like, Kotak Bank and HDFC Bank, especially in the last 1.5 or 2 months, where you've seen many of these stocks like Kotak Bank and HDFC Bank hitting fresh highs for themselves. But ICICI Bank is, lagging behind a bit. But I believe that, in terms of buying level or averaging level, I think a better level to try and buy and purchase it back would be if the stock comes back to those, sub, 440, 450 kind of a zone. So I think that's a, good enough range where you should be looking to average out further. There are some lot of, technical support, resistance, supports at those levels. Some moving averages, 50 DMA, for example, is at 430, 435. So maybe over the next couple of days, the averages will probably shift up higher as well. So I think in that regards, a 440 to 450 zone could be a good enough zone where you should look to average. Rather than buying this at current levels, I would suggest, wait for some bit of dip. And if the stock comes back to that kind of a territory, that will be a good level where you could look to average further and then hold on to it, because I believe it's just a matter of time whether stocks like ICICI Bank would probably try and play a catch up and cover up the underperformance as compared to its pure HDFC Bank or Kotak Bank.
Right, thanks for that, Kunal. And Gaurang, coming to you, ICICI Bank, it's a bit puzzling because HDFC Bank is at lifetime high, Kotak is at lifetime high, Bajaj Finance is pretty much at lifetime high. And this is all because earnings have been good. So for ICICI Bank, earnings have been just as good. So why are we still at 470, 480 instead of 550? And do you also think it's just a matter of time, or do you think there's some other point which needs to be discussed about ICICI?
Well, we as a brokerage house at Geojit Varun are extremely positive on ICICI Bank, and there are certain participants in the street who feel that there is certain amount of pessimism as far as the outlook for ICICI Bank's earning is concerned. But purely reflecting upon the last financial year, the first quarter, second quarter, and the quarters remaining third and the fourth and the next financial year, and given the kind of preference that we have as a brokerage house towards private sector bank, we believe that this is a great private sector bank to hold in your portfolio from a long-term point of view. And if you do have investable amount from a long-term point of view again, then use dips to accumulate the stock.
Gentlemen, thank you so much for staying on with us, for helping our viewers out as well with their queries and concerns. Slipping into a break here. More updates when we come back. Stay tuned. Welcome back. You're still watching Buy Now, Sell Now. Well, a lot of names from Motown seem to be in top gear and unperturbed from the lackluster way the benchmarks seem to be trading at this juncture. Let's pull up a few of them because auto sales numbers, several of them came in after market hours as well. The likes of Eicher, TVS Motors, even M&M for that matter. Not M&M actually, I was talking about Hero for that matter. So it's largely been a decent set of numbers as far as Hero MotoCorp is concerned. They've come in with 5.91 lakh units. A good uptake of 14% year on year, but yes, given the way they logged in more than 8 lakh units last month, there has been a bit of compression and bit of a slip as far as the month-on-month trajectory goes. For Royal Enfield also, the numbers were a tad bit disappointing. 63,782 units sold in the month gone by. Our poll was indicating to a figure in the excess of 66,000, but decent growth on a year-on-year basis regardless of that. Hero MotoCorp has also once again flagged off how they've done fantastic sales during the 32-day festive period from Navratri till all the way to Bhai Dooj. Various festive initiatives, strong pipeline of products, new age sales solutions, online and even offline initiatives are something that drove their sales for the festive period. The sales have also seen the company further strengthen their market share across motorcycle and scooter categories, and they believe that this uptick will continue given the heightened preference for personal mobility, especially for two-wheelers. So yeah, largely a decent set of numbers, I would say. Not a very significant negative surprise there as far as these are concerned. Tata Motors CV came in at 27,982 units, a tad bit disappointing. Tata Motors PV, solid set of numbers, 21,641 units logged in for the month gone by. Earlier this morning, we also spoke to the management of Escorts as Motown has shined in the month of November on back of festive fervour. We got up with him to understand the demand trends in the sector and the outlook for the coming quarters. Here's what the management of Escorts said.
Now, actually, the channel is totally, I think, hardly left with any severe inventory levels. So, actually, the channel selling is something which is important, which will happen. So far, we've seen the industry in the first 8 months of the year has grown about 15%. So, going forward, we expect the similar momentum will continue with the better wholesale and with the heavy harvest also happening, which we also expect this time. I should be record harvest. So, that should also further actually pump up the demand. So we expect it should be a very good season actually in February, March too. So I think overall for the full year, we expect the industry actually will have double-digit growth now coming in. Yeah, we are working on capacity expansion too. So as of now, our capacity is at 10,000 tractors per month, which we are doing. The last 4 months we've been producing at peak capacity levels and even going beyond that. So we are trying to ramp it up to level of 12,500 tractors per annum, so per month, which will be about 150,000 on our own capacity. And then we'll also have another JV capacity with Kotak, which will be coming up on stream sometime in the first quarter of next year, which will be another 30,000 units. So combined capacity should touch 180,000 tractors per annum by say August, September next year.
Okay, some good commentary coming out of Escorts on rural demand. But let's switch gears toward the telecom sector, which is in focus. Vodafone Idea is going to be hiking rates for 2 of their Red family plans that offer 80 gigs of data and 2 connections. The rates were previously priced at 598 and 749. Those will now be hiked to 649 and 799. So 50 rupee price hike is essentially what you're getting. We all know why. India has the lowest ARPUs in the world for telecom industry. We also have the lowest mobile bill standards in the world. So we've heard other promoters like Mr. Mittal come forward and say that it's not sustainable at the current levels and that we have to start taking tariff hikes. While this conversation has been on for a while, Vodafone seems to have finally made the move, taken a plunge and been the first essentially to hike their tariffs. Now that gives room for the competitors to also follow suit and increase their tariffs accordingly. This will help them to earn more EBITDA and hopefully deleverage quicker than was previously possible. So keep your eyes out on both these stocks. Jio as well to an extent. Airtel preempted the move. I think it moved yesterday and today it's pretty much flat, and Vodafone is also pretty much flat today at 10 rupees. But now let's go across to my colleague Pankaj, who's standing by with the details on the latest Pharma PLI scheme.
Well, it's a great response coming in to the PLI scheme from the government, especially from the pharma side. Now, when we look at the pharma side, there were 2 PLI schemes that were there. One was for the bulk drug, or commonly known as API, and second was for the medical device. This actually closed on 30th November, which is the last date of November. That is yesterday. And then you have received a great response. A total application of 215 players. The who's who of the larger ones have gone ahead and applied. So whether you have Cadila Healthcare, Healthcare, whether you have Aurobindo Pharma, IPCA, Dr. Reddy's, and who's who of the pharma industry have gone ahead and applied for this particular PLI scheme. Now, PLI scheme is under two schemes, as I told you. One is under bulk drugs and second is under medical device. Under the bulk drug, there is 90 days for approval, which of course the government will then look at their production incentive scheme that they have proposed and then go ahead and take it. And second is the medical device, where it is about 60 days is where the government will have to decide in. Now, it's a scheme which was completely announced earlier. Some of these companies will go ahead and do this capex. It could lead to a lot of API manufacturing going ahead. It could also lead to API exports. So a lot of things to watch out for. First, the next step will be whose application gets approved and how they execute it, and then probably the maths of this particular plant which they would put, or the particular capex that they would put. A good response coming in with 215, and the who's who of India Inc. in the pharma space applying for this scheme.
Thanks, Pankaj, for that. The big question a lot of people on the market are asking is whether or not IT and pharma rally would sustain in the long run. We asked market veteran Hiren Ved about the same. He is confident that the sectors are in a structural bull market and the leadership will not go away anytime soon. Listen in.
My sense is that the leadership of IT and pharma is not going away. So, I think they are consolidating, moving sideways, and I will not be surprised if all the stocks there, at least some of the leading stocks there, make new highs. We are already seeing that in some stocks like Divi's Laboratories, etc. But I think pharma and IT, in my opinion, are in a structural bull market, and they will continue to lead. It's just that every sector after re-rating goes through a fair phase of correction and consolidation, and I think that's what's happening. And I think people should seriously look at adding to their exposure to these sectors if they have not already done that.
Mr. Ved, the bull market in IT and pharma is here to stay. Which is quite interesting. Those sectors seem to be taking a bit of a breather lately. But let's go across to my colleague Jayesh now, because November saw plenty of target price upgrades on the back of September quarter earnings and economic recovery. Now Jayesh has analyzed the target price upgrades in the month of November. Let's listen in.
The target price for more than 70% of the stocks that are tracked by a minimum of 5 analysts have seen an upgrade, while we have 19% stocks that have witnessed a downgrade and 8% stocks have seen no change in their target prices during the month of November. As far as sectoral target price changes are concerned, all of the sectors have seen an upward revision in their target price. Led by the consumer discretionary space. Of course, this was on the back of the festive sales that we got in the month of November. So 8% increase on an average basis, followed by materials and communication 6% each. And then you had the likes of industrials, healthcare, real estate also witnessing about 4% increase in their target prices. The laggards were primarily the technology space along with the consumer space, and the energy space, which saw 1 to 2% increase on an average basis in their target prices. As far as stock specific action is concerned, there's a lot of large cap names that have seen an upward revision in their target prices. Let me start off with the Nifty names. Primarily Tata Steel and Tata Motors at the top of this list. More than 25% target price upgrade for both of these stocks. And then you have popular mid-cap names like SRF and Voltas that feature in this list, about 19 to 20% increase in their target price. And once again, you have other Nifty names featuring in the list like Grasim and IndusInd Bank, which has also seen more than 15% increase in their respective target prices. As far as downgrades are concerned, you have one large cap name that stands out over here, which is Vedanta. 10% decrease in its target price, along with the Yes Bank that has seen more than 45% decrease in its target price. And you have other financials like Union Bank of India, Edelweiss Financial, along with PNB that have also seen about 7 to 10% downgrade in their target price.
All right, thanks, Jesh, for that. It's time to unveil our quiz answer for the day. We asked you this morning which of the following FMCG players has the highest gross margins. The options are HUL, Imami, Dabur and Nestle. The answer to this question is Imami, option number B. We have a few champions as well who got it right. First is Sandeep Bommisetti and Bhumika. Congratulations, guys, and thank you so much for everybody else who's been taking part in the BNSN Quiz Connect every day. Thank you so much once again. Moving on, let's talk about the Burger King IPO. It has opened today for retail investors. Winnie joins us to tell us whether one should take a bite of it or not. Winnie.
The much-awaited Burger King IPO opens today, so we'll be very interesting IPO coming in over there in the QSR space. The company has a fresh issue of equity shares amounting to around rupees 450 crores, while they have an OFS of 6 crore equity shares. So we're going to keep an eye out, close eye on this IPO, and we'll keep you all updated about that. Talking a bit about Burger King, the company is one of the fastest growing international QSR chains in India, with around 261 stores as on September 2020. And despite being a late entrant, the first store which opened up in November of 2014, the company has seen a 2.95x growth in terms of their stores in FY 2020, as well as in terms of revenues in the last couple of years. Also, they have seen a 2.2x growth in terms of revenue, and the revenues for FY 20 were at around 841 crore. So very interesting growth also coming in over there. Now, talking about the money that will be used which will be raised, the funds that will be raised via the IPO, that will be mainly used for opening their more stores, expanding stores. So company aims to open 370 stores by December 2022 and around 700 stores by December 2026. So largely that is going to be used to expand their store base, as well as reduce the debts in the books of the company as well. Now, comparing to the peers, the company's average ticket value is at around 500 to 550 rupees, while the operating margins is at 12 to 14%, which is very closely in line with its peers as well. Obviously, the company has a strong customer proposition, as well as vertically managed and scalable supply chain. Coupled with obviously the stores that are opening up, the restaurants that are opening up is very good, and that could lead to a good performance for the company as well. In terms of SSSG growth, also obviously we have seen an impact on the company's SSSG growth in this first half of the year, but they have been seeing recovery, as what the management has also said when they spoke to us. So very interesting coming in over there, and overall SSSG growth of the company has also been quite good in the last couple of years when we compare it to its peers as well.
All right, thanks for that, Vinny. A lot of interesting information in there. But earlier this morning, we actually spoke to the Burger King India CEO, Rajiv Varman, and asked him about the company's plans post the IPO, the rationale for listing and use of proceeds. Let's listen in.
Let me share with you the investment highlights. I think that's good for investors to know. See, this is, first of all, world's second largest chain, right? It's in over 100 countries, over 18,000 restaurants around the world. So it's a very, very strong brand with large and very high following and awareness levels, right? Now, in India, we have a master franchise agreement with them. The master franchise agreement basically allows us to do two things. One is, of course, to run the business, but it also allows us the rights to run the brand, to execute the brand here in the country, which is a very important thing, because that helps us run our own supply chain, build our own menu product, get our own distribution system, run our own advertising, and build our own NPD product. So it's a very, very strong, attribute to have in a master franchise agreement. The other thing is, the franchisor is also part of this JV, part of this master franchise agreement, which is a good thing, because they don't do this in every other country. They do this very strategically in very good growth countries, and we are very glad that they're part of this JV here in India. Now, if you look at the agreement, it's a significantly long agreement. It's until 2039. So we have a long road ahead. And the growth target that we have committed with this master franchise agreement is to build 700 restaurants by December of 2026. So a large, vast road ahead as well for us to build this business.
In the month gone by, value funds witnessed high redemptions. So to analyze this trend and to understand what the fund's investing strategy is, we caught up with Meenakshi Dawar. She's the fund manager of Nippon India Value Fund on The Money Show. Here's what she said.
See, if you look at it, last 6-7 months, this was a period of very uncertain time for the markets. So, people did not expect that this kind of degrowth or, something like COVID will impact us so sharply. And people also didn't anticipate the recovery that market has shown. So as an investor, what happens is when there is a lot of uncertainty in the market, people tend to stick to certain few explored ideas rather than going very broad-based. And that is what happened in the market in last 6 months, that, whichever companies were delivering growth, which had, were able to deal with these near-term challenges better, have definitely done better than the broader market. But, and that is, what has led to so much of outperformance of growth as an investing style over value investing. But if you look at, where we stand right now, so as I said, market tend to price what is happening in the near term to perfection. So if any company has been able to do good growth, has been delivering better, that is already there in the price. So for an investor to make money from here on, it is very important for us to look beyond what is happening in the next 1 or 2 quarters. And therefore, it is very important for you to have a strong fundamental understanding of the business that you're investing in. So if the business is able to survive these cycles of, low growth, and therefore you are getting a good entry point into these businesses, that is when you make good returns on your investments. So this last 6 months have been into understanding what has been happening in the market. There was so much of uncertainty, and therefore people were sticking to very few ideas. But from here on, as and when the recovery becomes broader based, and a lot of companies which had disappointed or had not been able to participate in last 3-4 quarters of growth, as they come back to normalcy, you will see better returns from those names as well. And as I said, that there is enough and more margin of safety which is being built into these names. So as and when the economy becomes a little more broad-based, you will see far better returns from these value names.
So actually, I think you've responded to my next question as well. It was essentially regarding this one trend that we witnessed in the last couple of months. In general, investors have sort of been pressing the redeem button on, equity mutual funds as a category as a whole. But more specifically in the value fund category, I think it's with a bit more vociferousness that the redemption button is being pressed, because within the value fund category, we saw the most amount of net outflow, at least in the month of October. So would you advocate all value fund investors, or for those individuals who do have value funds in their portfolio, would you advocate patience, adopting a long-term approach, as opposed to just looking at the markets and saying, okay, look, they've rallied, and now that I'm a little bit in the green, let me just press the redeem button?
So so that's what exactly I was explaining earlier also. So whenever you're doing value-based investing, you have to be a little more patient, because, you are not investing for what is happening in the near term. You are investing in what is going to happen and what can happen for next 4 or 5 years. So therefore, it has to be part of your allocation, and then it has to be a long-term, you have to enter in.
Okay, completely out of time here on BNSN. Thank you for watching. Keep it with ET Now.